All right, folks, welcome to Leading Indicator, a show by Public.com, bringing you insights from the world's very best macro minds. I'm your host today, JD Durkin. We are here with you today to discuss equities expectations, yes, for the second half of 2023, and a few other asset classes for you all to keep your eyes on for potential adds to your portfolios. As always, do not forget to like, comment, and subscribe to all of our channels for more in-depth interviews to help you keep your portfolio on track. With us here today, very special guest, Jason Shapiro, founder of crowdedmarketreport.com. Jason, thanks for being here. Welcome to Public.
Thanks for having me.
So you and I are having this conversation at the kickoff of a very busy week. As you know, Q2 earnings season rolls along. We'll get the next FOMC Fed decision on Wednesday afternoon. We got fresh PCE data coming out at the end of the week. I think it would be helpful for investors and for people in the public family to hear your perspective on analyzing data like this. What are your thoughts overall on equities as a Q3 for this calendar year rolls along, Jason? What are you following?
So there's a few questions in there, I guess, but as far as the data and how to roll with the data type of thing, I come from a perspective, I have no ability to predict the data, so I don't play the game of trying to predict what the data is going to be. It's more important to me of how the data comes out and then how markets react to that data, right? Did they react the way that they should theoretically based on what the macro psychology is these days, or did they do something that was unexpected and therefore is there something interesting there? For me, if it comes out and the markets act as they should, then there's nothing really that interesting for me there, right? It's when something happens other than what theoretically should happen that, to me, there's possibly some opportunity. So, the Fed, what are they supposed to do? They're supposed to raise a quarter point and stay maybe a little bit to the hawkish side, I would think. So let's see if they do that, and let's see how markets react. And if they don't do that, obviously, let's see how markets react. That to me is the more important thing. As far as earnings, again, I'm not have any ability to predict what earnings are going to be. I couldn't tell you what, if these guys are going to beat or not beat or anything like that. I have no idea, nor do I believe anybody has any idea. But I don't even like to play the game because it's a waste of time in my view. Again, it's more about how things react after that than not. In general, how do I feel? In general, I have been bullish the stock market this whole year. I don't think that that's over yet. So do I think that it's going to continue to go straight up? I would be surprised if it did, although nothing surprises me anymore in the markets. But I do not think that the highs are in, would be my general take. Unless you're going to tell me that last Wednesday was the high for the year, then the highs are not in. And the Dow is making a new high as we speak. So I don't think the highs are in yet, which means that my bet would be we're continuing to go higher the third quarter.
Have you been surprised with any of the earnings results that we've had so far? I know you don't want to look necessarily into what's still to come, but we're already through the bank earnings. We do have a few of the Magnificent Seven names coming up this week, but so far, a lot of beats overall in terms of the S&P 500 companies reporting. Is that more or less in line with what your expectations were?
My thoughts coming into this year, I'm a sentiment person. I'm a sentiment and positioning person. Being very contrarian to sentiment and positioning. So the idea coming into the beginning of this year, from what I read, was that everybody was super bearish for the first half of the year because they thought there was going to be a recession in the second half of the year. And then they thought that the market would start to discount out the recession or discount the end of the recession in the second half, and the market would go up the second half of the year. So it did. So far, it's done the exact opposite. It went straight up the first half of the year. And I was hoping that then that would give me a sell for the second half, but it hasn't. So whatever. But the reason I bring this up is because going into your question of am I surprised that the earnings have been stronger? Again, everybody was discounting in a recession to come. So if they've already thought that there's a recession coming, then the odds of things coming out stronger, I believe, are a lot greater, right? If there's going to be a surprise, it's going to be a surprise to the upside, right? Doesn't mean there has to be a surprise, but if there's going to be a surprise, there's going to be a surprise to the upside. I thought the most interesting thing that I heard when everyone was sort of on this recession thing was an interview with, I think it was the CEO of MGM, the Las Vegas casino company. And he said, We are preparing for a recession, although we haven't seen any signs of it yet. So if you think about that, forget about a market participant. This is a real business person. If you are preparing for a recession, what does that mean, right? It means you're reducing your investments, right? And forget about the MGM guy. This was probably everybody, right? You're reducing your investments. So if the recession doesn't come, well, now you're behind, right? Because you prepared for a recession, it didn't come. Now you actually have to ramp up. And I think that's what we're in the process of people are going to need to do, because now they're underinvested and the recession hasn't come. So now they probably have to ramp up, which means that the growth will be even stronger. And then it'll get too strong. And then the whole Fed thing's going to have to come into play. And, they're going to have to raise rates and all that. But I think that that's where we are in the cycle. I think we're in a place where they didn't invest enough because they thought recession was coming. The recession didn't come, and now they're going to have to ramp up.
Do you think that a lot of that potential concern over a recession, albeit maybe a bit of a mild one, is just largely that there's just so much chatter in the space, and so everyone, whether it's the leader of MGM or any other company, is sort of looking over at the next guy, the next team over, and saying, well, they're worried about a recession, therefore we also need to be worried about a recession? Is that a little bit of kind of what's driving that sentiment, you think?
I think that's 100% how the psychology works. It's all about, job security, right? So if you're wrong and you were wrong with everybody else, then you don't lose your job, right? If you're wrong and you're the only one wrong, then you lose your job. So I think that's definitely how the psychology works. And of course, the people who get super rich, the billionaires, are the ones who actually don't care about that, and they will take the opposite side, right? And they will have an independent thought. But most people cannot have independent thoughts because you're risking your job security.
Yeah, and everyone in the space is very perceptive to chatter for people around them. So the main argument for your bullish case here sounds to be that the market has far too much short exposure, could lead to a little bit of a lack of fuel needed for further downside. How do you see terminated shorts like that kind of impacting overall markets here? I mean, I don't know how many people thought that markets would perform as well as they have here in 2023, yet this seems to be the story of the economic engine that just seems to be still just chugging along.
Yeah, I mean, I think it's driven by positioning. So I think people just came in way too short, and that's why the market's gone up so much, right? So I'm monitoring for when they get out of those shorts. Now, we've seen some of that be reduced by definition, because people who are momentum traders, people who are trend followers, clearly can't be short anymore, right? And theoretically should be getting long. But the fundamental people have not given up, from what I can tell, whatsoever. So therefore the market hasn't gotten super long. It's just more kind of a neutral territory here.
Well, the short thesis, rather, you think helped drive markets through the rest of 2023? I know it doesn't sound as if you're necessarily in the business of trying to prognosticate ahead, but if you did have to give a read about what the rest of the year could hold, what is your sense there for markets?
I think we're going up I think the stock market is going up until the fundamental macro bears give it up. And I don't know what's going to get them to give it up. It's been a very interesting time to watch that. Usually the market going up will get them to justify why they need to give it up. But in this particular case, they are digging in, right? They're digging in. Valuations are too high, and the macro stuff, the recession's coming, and the Fed is not going to lower rates and all that. And they're digging in. So it's going to be very interesting to see how they get out of this trade, because if the market keeps going up, then I mean, clearly valuations haven't improved if the market keeps going up, right? Valuations get worse as the market goes up. So I don't know where they're going to get out. I hear a lot of them saying things like, well, when the market goes down 25%, then I'll get bullish. Okay. I can't get a single person, and not just me. I've listened to them on TV, and a lot of these people have been given the question, what will change your mind? And nobody, I can't get anyone, or I haven't heard anybody answer that question. What will change your mind? Oh, well, if the market crashes, okay, fine. But what if the market just keeps going up? What will change your mind? I mean, new highs, will that change your mind? And sometimes people say, well, I got to get through earnings. If earnings are better than expected, then maybe I'll change your mind. If earnings are going to be better than expected, you're going to be changing your mind 15% higher, So that's to me is as far as the stock market goes, that's the big story for me. What is going to get these people to capitulate? Are they going to just stay short? Let's say that we're just what markets normally do, which is go up over time. And let's say they go up this year, and let's say they go up next year, and let's say you're missing out on the whole idea of dollar cost averaging and getting your 8% a year in an index fund. At what point do you say, hey, man, you got to be in that? I don't know what it's going to be, but that's what I'm watching, and it's going to be interesting.
And I appreciate that good faith chatter there on equities. Moving past equities, any other asset class I wonder that you're particularly bullish or bearish on at the moment?
I'm bullish dollar here, which makes me bearish gold and silver and all that stuff. It also makes me bearish fixed income for the most part. So my belief is that rates are going higher, the dollar is going higher from here, and that gold is going down, and silver for that matter.
At least so far, year to date, the HUI gold index has returned around 25%. What is your sense as to why we have seen gold perform as it has in the last year?
So gold year to date, I mean,
or over the past year, I should clarify. The past year, the HUI gold index 25%.
Yeah. Gold is usually a dollar thing, right? The dollar's been going down really since October of 22, I believe, is when the dollar topped, or maybe in September of 22. So, as the dollar's gone down, gold has, for the most part, gone up. But I have had trades where I was both long gold during that period and short gold. But right now, I would be short gold. So,
what do you think we're missing in our general conversation? Whether it's macro environmental trends, any of the things you and I talked about, like you said a few moments ago, you watch all the talking heads on TV. I wonder from where you sit, Jason, do you think we're not paying enough attention to this? What would that thing be?
I think that people pay too much attention to macroeconomic stuff. And not enough attention to things like sentiment and positioning. I'm a big believer that what drives markets is sentiment and positioning. And as far as macroeconomic stuff, I'm not the only one that'll tell you that. Warren Buffett will tell you that. I saw a thing with Peter Lynch the other day, which was a speech he gave in the 90s, where he was like, I'm going to get the quote wrong, but it had something to do with if someone spends an hour trying to analyze macroeconomics, they just wasted 58 minutes of their life. And look, Stan Druckenmiller will tell you the same thing, right? To me, there's so many levels of why focusing so much on the macroeconomics is wrong. First of all, if you think you're going to predict the macroeconomics better than everybody else over time, you're kidding yourself, right? Like what? How are you going to do that? You've got 80,000 economists on Wall Street, 80,000 analysts on Wall Street. And that's what's discounting in the market. How are you going to do a better job of that than them? A. And B is, so what? Because you're not trading the macroeconomics, you're trading the market. And sometimes the market doesn't trade with the macroeconomics. So you might get your macroeconomic call exactly right. The Fed is going to raise rates X amount of times, period. And then the economy is going to do that. You might get that whole thing right. But that doesn't mean you're going to get the market right. The market doesn't trade 1-for-1 or even close to 1-for-1 with the macroeconomics. I feel like if I had given you all the macroeconomic numbers on December 31st of last year, and we got to when I said to you, where's the market going to be on July 24th? If I'm giving you all the macroeconomics ahead of time, you wouldn't have told me that the stock market was going to be where it was, and that alone proves it.
So finally here, talk to our viewers who may, like many others, be a bit hyper-focused on the macro. Where instead would you encourage them to focus? You mentioned a few of those responses a moment ago, but in terms of having an actual tangible kind of takeaway or actionable item from this interview, where would you encourage someone focuses a bit of their time instead as well if they want to build out their portfolio or really just become a better informed investor?
I think that you need to focus your time. First of all, okay, so you have a view and it's based on macroeconomics. Well, you have to focus your time on, well, is everybody else saying the same thing as me? Because if they are, then how am I going to make excess returns, right? You can't make excess returns if you're doing the same thing that everybody else is doing, because everybody else doesn't make excess returns, right? By definition. So I'd say that's the first thing you need to focus on. And then you need to focus on how the market is actually reacting, which is more important, right? Forget about what I think the market should do, because the market could care less what you think it should do, right? That's what gets you in trouble, Focus on and be honest about it. How is the market reacting? And therefore, where should I be positioned based on that, right? Stop thinking about what you think and start thinking about what's actually happening. I know you want to think that this is what's actually happening and I know it's wrong, so there's something to be made there, right? The market's going straight up and I know it should be going down, so I can get short, right? It's not going to work. You're going to get run over and you're going to lose money doing that, whether it's short or long. I don't care, right? And I don't care what the asset is. To me, it's all the same. So I think that's what people need to focus on, their psychology, and there you go, and getting that out of the way so that they can just clear up and just let the market make the money.
I'm thankful for the context and perspective. That's Jason Shapiro, founder of crowdedmarketreport.com. Jason, thanks a lot for taking the time to join us. I really appreciate your insights.
It's a pleasure. Thank you.